So we have been waiting a long time for this, but the Bank of England has finally cut the base rate of interest here in the UK. The new rate as of August 2024 is 5%. That is a 0.25 percentage point decrease from where we were 6 weeks ago. I want to quickly take you through how that decision was made by the Bank of England. I've gone through the minutes so you don't have to, and also what that's going to mean for your savings and your borrowing, specifically what it means for people with a mortgage. So let's talk about the decision first of all. Now this is, let's say, been expected for a long time. It was the start of the year. They were already expecting us to get at least one cut in the spring, maybe 3 or 4 of them as the year's gone on. But each one of them has been pushed back, pushed back, pushed back. And in fact, even just a few days ago, they still weren't really expecting one at this meeting. September looked like the most likely time for that first rate. But it has come along, 5% down from 5.25%. And this has followed a year where the rate stayed exactly where it was. And that followed, a year and a half from December 2021 all the way through to the summer of 2023, where it increased from a low of 0.1%. So we had 14 consecutive increases, bounce, 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 jumping all the way up, then flat, and now we have come down. Now, this is good and bad news, depending on your take. Broadly speaking, it's good news. Good news because the reason why they have decided, the Bank of England have decided to cut the base rate is because they feel that those increases, having that base rate at such a higher level for such a long time, is working. And what it means by working is it is kind of steadying inflation, bringing it down. Remember, well, you can't forget, can you, how much more expensive things were, the cost of living crisis. It's still there. Things are still expensive, aren't they? But that jump in prices when inflation was really high, you want to bring that rate down, the rate at how much prices increase. And for the last couple of months, it's been at the Bank of England's target of 2%. That's how much prices are increasing, which is still means they're going up, but it's a lot better when it was at 10 or 11%, isn't it? So you increase the base rate, that hopefully brings down inflation, and it seems to be working. So good news, because you want inflation. We want inflation to be at that target, around that level. You want some increase, some growth, but you don't want it to be too high. So that's good news. So also, as we'll get to later on, good news for people with mortgages, potentially bad news for savers. We'll come back to that. But this increase has happened. So this decrease has happened, this cut has happened down to 5%. It wasn't necessarily an easy decision. There's 9 people on the Bank of England's Monetary Policy Committee, and they have a majority, basically, is what goes through. And this was a 5-4 majority, and in the minutes it says it was finely balanced. So 1 or 2 of those people were wavering. They weren't sure whether to stick or whether to cut, but they've gone through the cut and to bring it down. So most people think enough has been done for now. In the meeting minutes, it says that 2% where we are now, they've been saying this for a while now, they do expect it to increase inflation by the end of this year to 2.75%. That's largely down to energy price changes, which we already know are going to come into play. And then it's looking at in 2 years' time, inflation will go down to 1.7%, and in 3 years' time down to 1.5%. So they don't want to be going too far down, but broadly that's where it's looking. We don't think we're going to have any crazy high inflation for a while. So this happened. What does that mean now for future cuts? So we're going to see, now we've got one, are we going to see loads of them? In the same way, when we saw the increases, we saw them one after each, every 6 weeks, another increase with 14 consecutive meetings. Now, you have to take it with a pinch of salt because you never know what's going to happen. As I said, they were pricing in cuts at the start of the year that didn't happen. But the Bank of England's minutes, what they say is they think there could be one other cut this year, perhaps in November. That's what it's most likely they think. But again, this could absolutely change. We could have another one in September. We could have 3 this year. We could have none this year. But that's currently where they are looking at this happening. So one more cut to 4.75% by the end of this year. They've also got some models of where they think it's going to be going in 1, 2, and 3 years, the base rate. So they're saying in a year's time, so in August of 2025, they think the rate's going to be around 4.2%. So that doesn't suggest a huge number of cuts, does it? From where we are now, 5%, that's roughly another 3 cuts. For this one in November, it's only another 2 in the first half of 2025. Then in 2 years' time, 3.8%. So again, only another couple of cuts there. And then in 3 years' time, down to 3.5%. So only 1/3 of a cut in that entire year. Now, again, this is all predictions. It all changes. As you know, from if you're watching or listening to my updates on this base rate meetings for the last 4 years, this changes all the time. But that's where it is right now. And what you'll notice there, and this is no different to the predictions we've had a couple of months ago as well, that's still quite high. It's not 5.25%. It's not 5%, but it's still 3.5%. That's still much, much, much higher than what we have been used to in the most recent sort of history. You think about everything going back since the crash of 2008, and since then we haven't seen rates particularly high, but they've been very low. But we're not going back down to where those really rock bottom lows of 1% or below. So that's something to bear in mind and think about. Now, the next meeting is taking place in September. We'll do another update there to let you know what happens with that one and all the ones after that, of course. What I want to talk about now, though, is just what this might mean for your savings and your borrowing. Let's talk about savings first of all. This is obviously going to be bad news for the rates you're going to get. You will see almost immediately some rates drop down. Some of the popular easy access accounts, such as the ones from Chase and from Chip and places like that, they are linked to the base rate. They are actually tracking the base rate. So when the base rate drops, that rate drops. Now, I think in most instances, it'll be instantaneous. In some cases, they might give a bit of a window, day or two, maybe a week. But broadly speaking, those accounts are all going to fall down automatically, whatever you do. In terms of other easy access accounts, which aren't linked, tracking the base rate directly, I would imagine most providers are going to drop those as well. There might be one or two who want to sort of offer something right at the top of the table, but broadly speaking, I think we're going to see those ones go down, both for new and existing customers. Definitely for new customers, I think those new options will disappear. Existing customers, maybe a few places might stick at higher rates for a bit, but I think that's the end really pretty much now of 5% easy access accounts. I think they will go. Those kind of more specialist accounts that I talk about when I do my updates every month, or that we share over on becleveryourcash.com/savings, where you're getting at the moment like 7% for a regular save with First Direct, 7% for a year on up to 4K with a Santander Edge account. They potentially could fall as well. So, remember, a lot of them were very slow to offer us these increases as they were in crypto accounts, but they'll be quite fast to take this money back. So that's the case there. Fixed rate accounts, potentially, again, we could see them dropping in the coming days and weeks as well. Although there is a good chance with some of those, or many of those, they already would have priced in. Remember, we've been predicting a cut at some point this year for a while, so they may already have gone, right, we're offering this rate because we know one cut is coming, potentially two. So one or two of them might still stick around the rate we've got right now, but we have been seeing them falling as the year's gone on because of that. But I wouldn't be surprised if we see more of them disappear. So if you have got money you can lock away and you haven't done already, it might be worth just looking at the best buy tables over on the website, opening up the account. You often got about 14 days, sometimes longer, to put your money in there. So at least you've got that rate while you can, but don't expect many to stick around for too long, as it is on savings. If you already obviously have a fixed rate account, then that's not going to change at all. But obviously when that matures, whenever it is, then the rates you'd like to get will be lower, but not as low as they were. Again, if we're looking at over the next 2-3 years, still around that 3.5% rate, that does mean we're still going to be able to get fixes around there, which, if those inflation predictions are still come true as well, of being around, that sort of 1.75%, they're still beating inflation. That's always really important with your savings. You want that rate to beat inflation. And we'll keep you up to date on what's going on there. In terms of borrowing and mortgages, then this might be really good news for you, particularly if you're on a tracker mortgage right now, because the same way that tracker savings account rate will automatically drop for savers, a tracker mortgage will also automatically drop for borrowers. So you will be saving yourself money straight away. And I saw a figure somewhere saying like the average mortgage on a tracker right now will be saving 25 quid a month. Obviously, that will depend on the size of your mortgage and the rate that you've got right now. But that is going to be good news for you. You will be starting to save money. If you're on a variable rate mortgage, then you probably will see a change too. Variable rate mortgages don't have to change. They don't have to change by the same amount that the Bank of England has cut the base rate. So they might not give you the full 0.25 percentage point decrease. They might not change it at all. They could even increase it if they wanted to. But you should hopefully be seeing some savings every month. Saying that, of course, being on the standard variable rate is often the most expensive option out there entirely. And you might be better off, even if we're anticipating further cuts coming along, seeing what else is out there. Maybe moving to a tracker might be a better bet for you, as long as there aren't penalties for you getting out of them. In terms of fixes, well, if you're already on a fix, same with a fixed savings account, there's no change right now. Nothing is going to change. But if you are due to remortgage soon, you might be thinking, great, timing for this is perfect. I can get myself a better deal. The problem is, you might find, in the same again as we had with the fixed rate savings accounts, a lot of the providers, the lenders, have already priced in this cut. If not just this cut, but maybe other cuts this year. So the ones right at the top might already be amongst those ones which are kind of like a rate with that cut already in place. No guarantee though. So the best thing you to do there is obviously keep an eye on different rates available. But I think talking to a mortgage broker, they'll have a better sense of the entire market. They'll know kind of which ones might already have priced things in, which ones could actually be about to drop, and you get in there as soon as you can. Remember, with the majority of mortgage providers, they will let you lock into a new deal up to 6 months before your deal is due to finish. So you could, get, even if you aren't due to get one right now, get a rate and lock it in. But make sure, particularly if we're going to this cut, and particularly maybe if other cuts come in this year, you might want to ensure that you can get out of that without any penalty. So avoiding the ones with the large arrangement fees up front that are non-refundable, just in case we do see this cut, one, impact rates available right now, but two, another cut potentially this year. Again, there could be none, there could be more, who knows, but other ones coming along in that next 6 month period could bring it down further. So you want that flexibility to get out and pick another deal if it comes along. Again, talking to a mortgage broker will help you with that. Very quickly, in terms of other borrowing, this cut will be good news again, potentially, but again, there's no guarantee that they are going to pass this on to things like overdrafts or credit card interest rates or loan rates, any of those things. They don't have to do it. You'd hope they will. And in terms of competition, a few places might respond to this. But broadly speaking, if you're already in a deal, that's unlikely to change, like a loan or car finance. But if you're looking again, obviously do shop around and see if there are better deals for you. My name's Andy Webb. Thank you so much for watching this. Check out these videos for more ways to make the most of your money.